When it comes to managing money, few topics spark as much debate as the comparison between stocks and life insurance. On one side, you have the stock market, widely known as the engine of wealth creation. On the other, you have life insurance, often marketed as a safe, stable, and even strategic financial tool. But here's the reality that many people don't fully hear. These two options are fundamentally different, and the way they are often presented can be influenced by incentives, commissions, and incomplete information. That's why this breakdown matters. If you truly understand how stocks and life insurance work without bias, you can make smarter decisions that align with your financial goals rather than someone else's sales agenda. Today, we will talk about Financial Advisors Hate This: Stocks versus Life Insurance Breakdown. So, before we start, make sure to hit the like button and subscribe to my channel. Let's start with stocks, because this is where most long-term wealth is actually built. Stocks represent ownership in companies. When you invest in the stock market, you are participating in the growth of businesses, benefiting from profits, expansion, and innovation. Over time, this growth translates into increasing stock prices and, in many cases, dividends. Historically, the stock market has delivered average annual returns of around 7% to 10%, making it one of the most powerful tools for building wealth over the long term. One of the biggest advantages of stocks is compounding. When you invest consistently and reinvest your returns, your money begins to grow exponentially. This means that even modest monthly contributions can turn into significant sums over decades. The longer your time horizon, the more powerful compounding becomes. This is why many successful investors emphasize starting early and staying consistent. However, stocks are not without risk. Market volatility is a natural part of investing. Prices can rise and fall due to economic conditions, global events, or investor sentiment. This can be intimidating, especially for beginners. But here's the key insight. Volatility is not the same as loss unless you sell during downturns. Long-term investors who stay disciplined and avoid emotional decisions are typically rewarded over time. Now let's turn to life insurance, specifically permanent life insurance like whole life or universal life. Unlike stocks, life insurance is not primarily designed for growth. Its core purpose is protection, to provide a financial payout to your beneficiaries when you pass away. This death benefit can be crucial for families who rely on your income or have significant financial obligations. Permanent life insurance adds another layer by including a cash value component. Part of your premium goes into this cash value, which grows over time at a guaranteed or semi-guaranteed rate. This is often where the marketing becomes more aggressive, with claims that life insurance can also serve as an investment or wealth-building tool. Here's where the breakdown becomes important. While life insurance does offer growth through its cash value, the returns are typically much lower than what you can achieve in the stock market. On average, whole life policies generate returns in the range of 3% to 5% over the long term. This is significantly less than historical stock market returns, and over decades, this difference can result in a massive gap in total wealth. So why do some financial advisors strongly promote life insurance? The answer often lies in incentives. Life insurance products, especially permanent ones, tend to have higher commissions compared to other financial products. This doesn't mean all advisors are acting in bad faith, but it does highlight the importance of understanding the motivations behind the advice you receive. Another key difference between stocks and life insurance is flexibility. Stocks offer a high degree of control. You can choose where to invest, adjust your strategy, increase or decrease contributions, and access your money when needed. Life insurance, on the other hand, is more rigid. Policies come with fixed premiums, structured terms, and potential penalties for early withdrawal or cancellation. Liquidity is another area where stocks have an advantage. If you need access to your funds, you can sell your investments relatively quickly. With life insurance, accessing your cash value often involves taking a loan against the policy. While this can be useful, it's not as straightforward as withdrawing from an investment account, and it comes with interest and potential risks if not managed properly. That said, life insurance does offer unique benefits that stocks do not. One of the most significant is certainty. With a properly structured policy, you have guarantees. Guaranteed death benefit, guaranteed growth, and predictable outcomes. This can provide peace of mind, especially for individuals who prioritize stability over maximizing returns. Another advantage of life insurance is its tax treatment. The cash value grows on a tax-deferred basis, and policy loans can often be accessed without triggering taxes. Additionally, the death benefit is typically paid out tax-free to beneficiaries. These features can make life insurance a valuable tool for estate planning and wealth transfer, particularly for high-income individuals. But here's the truth that many people overlook. Stocks and life insurance are not direct competitors. They serve different purposes. Stocks are designed for growth, while life insurance is designed for protection and stability. The problem arises when life insurance is marketed as a replacement for investing, which can lead to suboptimal financial outcomes. One of the most effective strategies that often gets overlooked is combining both. For example, using term life insurance for affordable protection while investing aggressively in the stock market allows you to maximize growth while still protecting your family. This approach leverages the strengths of both tools without overpaying for unnecessary features. Behavior also plays a major role in this discussion. Many people struggle with investing because of emotional reactions to market volatility. They buy high, sell low, or stop investing altogether during downturns. Life insurance, with its structured payments and lack of market exposure, can help enforce discipline. However, this benefit should not overshadow the importance of learning how to manage investments effectively. Another factor to consider is time horizon. Stocks tend to perform best over long periods, allowing you to ride out short-term fluctuations. Life insurance, particularly permanent policies, also requires a long-term commitment to realize its benefits. In both cases, patience and consistency are key. Risk tolerance is equally important. If you are comfortable with market fluctuations and have a long-term mindset, stocks offer greater potential rewards. If you prefer predictability and guaranteed outcomes, life insurance may provide a sense of security. Your personal comfort level with risk should guide your decisions. Here's an additional perspective that often gets missed. Financial success is rarely about choosing the perfect product. It's about avoiding major mistakes. Overpaying for low-return products, failing to invest consistently, or making emotional decisions can have a far greater impact than the specific tools you choose. By understanding the true role of stocks and life insurance, you reduce the chances of making these costly errors. Another important insight is control. With stocks, you maintain direct control over your financial growth. You decide how much to invest, when to invest, and where your money goes. This level of control can be empowering, but it also requires responsibility. Life insurance, in contrast, is more automated and structured, which can be helpful for some individuals but limiting for others. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.